Welcome to the B.F. Anderson Technical Report for October the 18th. One of the best books, there's a lot of really good books out there on investing in the stock market and investing overall. And one of the best books I have read that had a really big impact on me was a book written in 1957 about a guy named Nicholas Darvas and his adventures of really learning about investing. The book is interesting because Darvas was a professional dancer like a Fred Astaire, and we're talking 1957. That was when all that was really a big thing. And the book is a good book because it kind of takes you from the beginnings of an investor's life with investing and the mistakes that he made, and then he learned from his mistakes and then just made some tremendous observations. And he made $2 million back in 1957, which was a lot of money. But let me read this quote to you. It says, "I did suspect one thing, however, and that was that the leaders in the previous market would probably not lead again. I felt sure that they had fulfilled their place in history, and they would not, for the first time being, reach for the same dizzy heights that had brought so much money to the investors who had followed them." So what Darvas is trying to explain there is that a lot of times, and really most of the time, the market will go through a correction period and everyone's trying to figure out why we're having this correction. Is it a bear market? Is it a really bad thing? And a lot of times it's just nothing more than a rotation, a changing of the guard, where certain stocks that have been really red hot, or certain sectors of the market that have been really red hot in the prior bull market prior to the correction, it's nothing more than a changing of leadership. So sometimes these corrections are nothing more than a group of stocks running out of steam and then a new group emerging. So what I did, and we'll get started here on the graphs, what I did was I went back and looked at our top performing stocks for the last, as of last night. And then I went and looked at the industry groups that they were involved in. So here we have the Dow Jones Medical Equipment. Now you can see here, just like everything, you had the waterfall decline starting to stabilize. Here we have an interesting group called the Telecommunications Equipment Group. Again, same problem, but you are starting to see a little bit of recovery here. Here's pharmaceuticals. Actually, looking kind of like the strongest group of the group. Here's semiconductors. Now you can see here a lot of damage done here to the semiconductors. They've come down. Technology is kind of acting a little tired. Here is software. So you can see that these were the five groups that appeared to be the strongest, but nothing that I'm seeing is in a strong uptrend. So let's go to the put-call ratio so we kind of get a measurement on sentiment. We have entered the fear range of the indicator. Now remember, this is a 15-day moving average of the put-call ratio. We got down into extreme greed. And one thing to notice about this graph is that we seem to get into greed and then we go straight into fear. And then we get into fear, and then we go straight into greed. So it's a very volatile, short-term indicator. But I do think it's important to realize that the market, back at the beginning of the year, we went into correction when we got into extreme greed. Back in the summer, we went into correction because we were in extreme greed. We barely got into extreme greed, and here we are, we're back in correction. Now, this is the S&P 500 index. You can see we've broken both moving averages and are starting to stabilize. But one thing about the fear greed index is, and relating to this graph, I'm really not sure that we're out of the woods yet. I'm thinking that my experience has been that when you get these corrections, they tend to end with a real high degree of panic. And really, one of the best ways to see panic is when you start to follow mutual fund redemptions, where people are getting out of their stock mutual funds in a large way. We're looking at an indicator, we're using an indicator, in fact, that where we're measuring the redemptions of mutual funds, and I'm talking about all funds, exchange-traded funds, mutual funds, etc. And when that number gets over a 5-week period, if that number gets to be around 20 billion, 30 billion, that's pretty much a panic. Right now, as of the last reading, and this comes out every Thursday, so it'll be out tonight, last reading was about 7 billion. So we're not quite seeing any panicking yet, but that could be coming. But I continue to recommend that you maintain a very defensive posture right now. Here's what we call the canary in the coal mine. This is the small cap index. You can see up here that it really started breaking down first and has had a really steep decline and is somewhat trying to recover. I would keep an eye on that index. Now, I am continuing to keep an eye on Amazon as one of the leaders, the prior leaders, or it may continue to be a leader. But it does look like the stock is somewhat broken down. A break below 1850 was troubling, but it does look like it's going to hold this 1700 area, and it's been bouncing really between 1800 and 1850. So I would look for Amazon to stabilize. Now, the same thing goes for Apple, but you can see here with Apple, you really have a much more stable situation. We've actually recovered above the 215 area, and we're starting to consolidate a little bit in this area here. So I would keep an eye on Amazon and Apple. Now, let's go into the top 5 here just to kind of see what are some of the strongest stocks in our database. Now, realize now, our database right now is about 3,600 stocks. And last weekend, I went through, I wouldn't say all 3,600, but I went through a lot of stocks, and they're all looking the same. They all have a very similar pattern, which is, what I call a waterfall decline and some stabilization in here. But this is Advanced Micro Devices, which would be pretty much one of the few tech stocks that are continuing to hold up. Now, here's a company called Endo Pharmaceuticals. Again, as you remember from the prior graph, the pharmaceutical group is holding up the best. This stock is somewhat holding up. Here's another medical equipment company called Glukos. And you can see it's pretty much stabilizing, but still not in an uptrend. This is not really what I'm looking for. Now, here is one stock that we own. I have to disclose that. This stock, you have to realize now, this company stock was about 6 months ago was around $3-4 a share, and it's now 37. Now, this is a company called Intelsat Global. They operate 50 satellites, and they have a satellite network, one of the first global satellite networks out there. The main thing that's interesting about this company, now they report earnings next Thursday, and one thing I'd be really looking for, they've got a lot of debt, and they're restructuring their debt, and I believe that's one of the main reasons the stock is acting so well, is they're getting their debt under control. But also, they're going to be very involved in a new technology called 5G. So if 5G pans out, this could really be a big deal. Now, 5G is going to be a big deal. It's something you really need to keep your eyes on. It could be as big as the internet itself. All right, here's the last one we're looking at, a little software company called Trade Desk, which is in the the advertising, cloud-based advertising analysis business. So all in all, what I'm saying is keep some powder dry, really limit any new buying right now. Let this thing stabilize. Like I say, the one thing about the fear-greed index, once that fear gets started, it can kind of really get out of hand, and we start seeing a bunch of mutual fund redemptions. That might be the time to really step up to the plate. But right now, I would continue to kind of keep it cool. Let me know if you have any questions. Thank you.